Hello, everyone. How are we feeling? Ready for break, huh? Is that where we're at? Yeah, I'm right there with you. I actually got some exciting news. I'm having a family member visit me over break, which I can't actually leave town because I got stuff to do. But that's kind of nice. Get a little joy, a little bit of relaxation for break. So stick with me. Two more class periods and we'll be done, and then you all can enjoy your break. We're not meeting on Friday, just for clarification. I guess I should clarify all of the plan for the rest of this week. So today covered chapter 17, completing the audit engagement. All right, so there won't be too much of that. We will wrap up our discussion of the coverage for exam 2 next week, or not next week, the week after spring break. We'll cover chapter 18 and chapter 21 on Wednesday, and then we'll have our homework assignment over chapter 17, 18, and 21. And then we'll be moving into exam 2 review after that. So something to look forward to after spring break. Yeah. Then Wednesday, I do have a request for everybody on Wednesday. So Wednesday, we're going to be working on a research project that or you are going to help me with the research project I've been working on. So I've added an assignment. You can find it either under the content folder here in week 8. Probably can't see it right now because if I recall correctly, I've made it hidden. So let me go ahead and make this visible. It's called The Cryptic World of Crypto and make it visible to users. And it's just a link to a Google Drive folder. Real quick to make a note here, in order to be able to access this file and access these files, you will need to log in to Google Drive using your Truman State link. If you have a personal Google Meet or Gmail account and try to use that to log in and send me a request, I probably will just send you a polite reminder that you need to use your Truman State account to sign in for this. Basically, this is just preparatory work. It will not require a lot of your time. I think I say 30 minutes of your time in the document. It should actually be a lot less than that. There is basically a disclosure document that kind of tells you what you're going to be doing as part of the activity to make sure that you're comfortable with being in a research project. And so we kind of have required to do that as part of our researchers. Then there's a pre-quiz, which pre-quiz is pretty straightforward. Just answer the questions to the best of your ability. If you don't know the answer, polite request. Make sure that you just say, I don't know. If you legitimately do not know the answer, do not guess. Truman students are fantastic, but they always want to try to make sure they give it their best effort. And I had a problem with this last semester when I was doing this. The group that I worked with was great. It was a bunch of people in BS 8153, and they worked really, really hard. But on the quizzes, when they didn't know, they were like, I am not going to say I don't know. I'm going to guess. Okay. And there were a lot of wrong guesses. So if you don't know the answer, it's fine to say I don't know. This is not a graded item, or not great. I'm not grading on your accuracy to answer. So please just answer to the best of your ability. Then there's some slides and some videos for you to review because we're not going to have time to do it in class. The videos themselves, you're probably thinking Dr. Barnes says it's a short video. It probably means it's like 30 minutes. It's actually like one video is 5 minutes long. One video is 7 minutes long. So legitimately will not take more than 30 minutes of your time to do all this stuff. But that's preparation for Wednesday. Wednesday, we're going to come into class. Remember, we're meeting over in 1432 for this class because I want you to have access to Excel. I will make all the files available to you so you can actually work through this. But this is going to be related to the two activities that you're going to be reviewing the videos on. And you'll notice the first one is has anybody heard of the company FTX? Have you heard of the term FTX? This is actually a case study over FTX and kind of their issues, the regulation. And then we're going to be talking about accounting for crypto assets. Is anybody familiar with how to do accounting for crypto assets? Probably some of you who've done VITA. Oh, it's really okay. So yeah, so you're gonna have some passing familiarity with what we're talking about. Yeah, it's a fascinating topic. It's a little bit unintuitive. So yeah, we'll get it. And not to spoil it, but we talk about it in graduate accounting as well. So you're going to be the expert in there. I'm just going to let you handle the class session then. But yeah, that's going to be what we're going to be discussing on Wednesday and going into detail on that. So yeah, hopefully we'll learn something as a part of the activity. Today, we're going to be talking about completing the audit engagement. So I know that we're probably not theoretically, or not, I'm sure I shouldn't say theoretically, we're not practically there yet, but we're theoretically there because we've talked about all the phases of the audit. We've talked about what's contained in there. We've talked about the procedures. And you're probably saying, Dr. Barnes, I do not feel like if I went on an audit that I would know what was going on. And that's fair because we have not talked about the specific audit procedures because we've not reached the point where we talked about the business process areas. But what I'd like to do is I'd like to jump ahead a few chapters and talk about after we complete the audit, what do we have to do to wrap up? Okay, after I shouldn't say, after we've completed all of our procedures, our testing, what do we do to conclude? And this is what this chapter is going to be talking about. So keep in mind that at the very end of the audit, we're going to be issuing a report. And that's what chapter 18 is. And we've saved that for after break because we saved the best for after break. You know, I want you guys to have a reason to come back from spring break. And so we're going to be talking about that. And then we're going to be talking about some attestation and insurance questions a little bit after that. But for today, we're going to talk about what it is that we do to kind of put the final cap on the audit. And these are considered to be testing procedures, but they fall outside of the scope of substantive tests. These are more just wrap-up steps saying what is it that we want to do to make sure everything looks good. And some of these are going to seem very familiar because they're going to cover concepts that you've covered previously in other courses. For example, one of the very first things that we're going to do when we conclude the audit as auditors is we're going to perform a review for something called contingent liabilities. So everybody remember contingent liabilities from 303? Yeah, I shamelessly stole this screenshot from the 303 textbook right here. At least the 303 textbook that I used back when I was doing it. I don't know if Dr. Shawnee, when he talked to you, he was using the same diagram. But remember, for contingent liabilities, definition of contingent liability is an existing condition or set of circumstances involving uncertainty about a possible loss that ultimately be resolved when some future event occurs or fails to occur. And the rules for contingent liabilities are pretty straightforward. If it's probable and at least reasonably estimable, you have to actually accrue a liability associated with that. That's the gap requirement. So basically says you have an idea of what the liability is going to cost and you think it's probable that it's going to occur, then you need to actually record it in your financial statements. If it's less than that, if it's only reasonably possible, or if it's not reasonably estimable, that's when we have a disclosure note. If it's remote, then we just basically say it's not going to happen, so we don't have to do anything. So those are the gap rules. Those are good to know, but that's not necessarily what we're concerned about as auditors. As auditors, we're trying to determine, does a contingent liability exist? And if so, has a client treated it properly? Now, let's talk about the reasons why a client might not want to disclose a contingent liability. There may be reasons for fraudulent purposes. They may be trying to understate their liabilities, but might there be a more rational reason? Let's say an example of a contingent liability, a good example of this is a lawsuit. Is everybody familiar with the idea of lawsuits as contingent liabilities? Lawsuit that's ongoing and pending and has not reached settlement yet. And so you're trying to determine what is going to be the eventual outcome of this lawsuit. So you probably talked about this back in 303, and if you didn't, it's a tragedy. But let's talk about it in this course at the very least. Might there be a reason why you have a client that does not want to admit that they are going to lose the lawsuit? So they don't want to disclose the result of the lawsuit. Like, so your accountants have said, your accountants and your law team have come together and said, it is likely we're going to lose this lawsuit and we're going to be on the hook for $1 million. So by GAAP rules, your client says that your client's supposed to record a $1 million contingent liability in their financial statements. Might there be a reason why they do not want to record that liability, other than the fact that they don't want to record a liability? So if you record a liability associated with a lawsuit, aren't you effectively admitting that you're guilty? Aren't you effectively admitting that you've lost the lawsuit? So the client may come back and say, we don't want to actually make this accrual, because that would effectively saying that we're admitting guilt in there. That's a big argument when we talk about contingent liabilities, is the effective admission of guilt. So the law team may say, do not record that accrual, because that undermines our case to do that. But we as auditors have responsibility to make sure that the rules are being followed, okay? So we have two-tiered step. We want to make sure we understand how contingent liabilities are generated within an organization, and then evaluate whether contingent liabilities have been properly treated. So what are some things that we can do for understanding? So things we can do, we can inspect records and documents, specifically meeting minutes for corporate governance and shareholder groups, sales and purchase contracts, loan agreements, leases, tax returns, and guarantee arrangements. So these are all documents that we would look at to try to determine if a contingent liability related to these items might exist. Also, we want to understand confirmations or send out confirmations, specifically to financial institutions and lending agencies, to determine if they have any knowledge of the contingent liabilities that may exist in these areas. So again, these are more for clarification purposes. This is not so much an evaluation of contingent liability, but an understanding of whether or not a contingent liability might exist, and if so, what areas of the organization they may exist in. What about some other steps? Well, near the completion of the engagement, the auditor should take steps to identify contingent liabilities. So this is a point where we're trying to determine, if we understand the business, what are some areas where contingent liabilities might exist? So we want to talk to management and say, what is your process for identifying and evaluating contingent liabilities? Say, talk to management and say, explain to us this step. If a contingent liability comes up, how do you disclose it? What is your process for determining whether or not it needs to be accrued within the financial statements? And what is your process for evaluating contingent liabilities as a whole? Now, keep in mind, this is an inquiry step. We already know that inquiry cannot be the last step in the process because it is not a high reliability evidence. Management may have a very vested interest in trying to lie to us about contingent liabilities because they do not want to accrue contingent liabilities. So then we're going to examine correspondence with the attorneys for pending or threatened lawsuits, because this would be a big area of contingent liabilities we might want to know about. We're also going to obtain a legal letter that describes and evaluates all pending litigations, claims, and assessments. We're going to get to that in just a second, because the legal letter can be both our best friend and our worst enemy, but we'll talk about why. We also want to obtain a written representation from management that all litigations, claims, and assessments have been disclosed. In other words, we as auditors are going to do our best to identify all contingent liabilities, but we're going to admit that we're only human and that we can't do everything because we don't know the client as well as they do. So management's going to have to actually tell us, all right, you are aware of everything that we have knowledge of with respect to contingent liabilities. And if something comes up later, we can actually backtrack on this and say, management said this was all there was. We have written proof of this information, all right? We're trying to cover ourselves just in case something comes up in the future. Now, whether or not we should be held liable, that's kind of an issue for the courts to decide, because they may say, you as the auditor should have known better. That's the issue with being an audit. Sometimes they'll say you should know better, even if they weren't fully disclosed in that situation. Anyway, we're going to rely very heavily on a group that I do not like to rely on, okay? And that's this group right here, the lawyers, okay? So that guy right there, that guy right there, and nobody knows it, but this guy right here, this is Alan Davis, okay? This is the worst of the three by far, okay? But yeah, got to rely on the lawyers, and I do not like trusting lawyers. In fact, Professor Templeton will tell you, this is, I say he's a nice guy, but he's also a dirty lawyer, okay? I know the DSP folk in this room say, how dare you, Dr. Barnes? Scotty T is immaculate. Scotty T is a lawyer, okay? By definition, he can't be immaculate. I'm sorry. No, we are going to rely on the lawyers to some degree, but we need to be very, very clear on what information we're going to gather from the lawyers and what form that should take, okay? So we are going to actually send out to the client's lawyers a letter of audit inquiry, which the vernacular for that is called a legal letter. And basically, this is a primary means of obtaining or corroborating information about litigation claims or assessments. That's what the book says anyway. What I'd like for you to do if you're taking notes, when you write down the word obtaining, I'd like you to scratch it out. Scratch it out so you can actually still see it's the word obtaining, okay? But I want you to note that the book says that you obtain information, and Dr. Barnes is saying, no, you don't obtain information. And why is that the case? So let's say that I'm a novice auditor and I go and I talk to the lawyer and says, you know what? The client has not shown any contingent liabilities. I think that some exist, but I don't know where they are. Could you, as the lawyer for the client, please tell me what contingent liabilities the client has? What do you think the lawyer is going to say? What do you think this guy right here is going to say to you? Okay. He's going to say, well, if the client says there's no contingent liabilities, then there are no contingent liabilities, because who does that lawyer represent? Does the lawyer represent you, or does they represent their client? Their client, okay? They are basically disclosing only information the client says that there's need to know. So a legal letter is a very good form for corroborating information that you already know about, but it is not generally going to be effective in obtaining new information, because the lawyers are not going to volunteer that. And this is not me bashing on the lawyers at this point, okay? I was obviously joking about it. I have high regard for Scotty T. He's a fantastic human being, okay? But their responsibility is to their client, as it should be. And if their client has not disclosed information to you, they're not going to disclose additional information as well. So unless you come to them with the specific information, specific details, and say, hey, I learned about this, can you clarify that this is the case? Then the lawyer will say, oh, I'm your best friend. Let me tell you all about that. They will give you the information to help you clarify, to help you corroborate that information. All right. Related to what we just talked about, I want to talk about commitments. So companies often enter to long-term commitments to purchase materials and sell products at a fixed price. Why? To obtain favorable or predictable pricing or secure the availability of materials, okay? Now, There's some interesting features about commitments when we talked about this. So accounting standards require commitments to be disclosed in the financial statements, and in many situations, there are going to be adjustments to OCI for any gains or losses. These are usually long-term items that are treated somewhat as pseudo investments to a degree. I think it's hard for me to actually say that these are truly investments because these are considered liabilities, but they do actually put many companies into advantageous financial positions, so they do have to be treated that way. One of the most famous examples of a commitment that I can bring up has to do with the fuel hedges that Southwest entered into the mid 2000s. So mid 2000s, in case you're aware, so back in late 90s, early 2000s, gas was running about $1 to $1.50 per gallon on average. Okay, and I know you're looking at that now. It's like that can't be. That's just way too little, Dr. Barnes. We pay like two something at least a gallon. You must be thinking of the medieval times, the Middle Ages. No. Okay, back when you were very young, back when maybe even before you were born. Gasoline was actually there was a point in time where gasoline was less than $1 a gallon, and I know, okay, that had to be before there was even computers. Okay, that was back before that. It wasn't actually that long ago. But in the mid 2000s, gasoline prices spiked really heavily, back to $3 to $4 a gallon in the United States. Southwest Airlines had entered into a series of agreements with their fuel providers that they basically secured a price at a low cost. And they had secured those prices for like 3 years in advance. So while fuel prices were rising to $3 to $4 a gallon, Southwest was still paying $1 to $1.50 a gallon for their fuel. So the reason this is important is because this is a piece of information that was needed to be disclosed to stakeholders because it actually affected prices for the future. So Southwest had record profits for about a 3-year period, and then all of a sudden they came plummeting back to earth. Pun not intended. They came basically coming back to where everybody else was operating at because they no longer had those secured commitments. So these commitments can have a massive impact on financial statement performance, which is why we need to make sure we have a better understanding of what these commitments are as auditors. The good news is I'm not going to teach you anything new, okay? Because usually these are going to be identified through inquiry of revenue and purchasing personnel and reviewing the minutes of board of directors meetings. Basically, they're same as contingent liabilities. So we treat them the same as contingent liabilities. This would include including information about that in a legal letter to make sure the entity's attorney can provide any information about details in that. The auditor's main concern related to commitments is assuring that appropriate disclosures are provided in the financial statements. For example, if I was the auditor on Southwest back in the mid 2005, I would make sure to say, these are periods of record fuel prices. We have secured at a much lower price. When these hedges run out, we're not going to have these record income years anymore. We're going to be actually back where the rest of the industry is, just barely breaking even. So that's something that a stakeholder would want to know for future reference. All right. That was kind of the boring stuff. Now we're going to have the fun part. We're going to talk about subsequent events. Subsequent events. Everybody remember subsequent events from financial accounting classes? So a subsequent event is an event that occurs after the balance sheet date, but before the issuance of the financial statements and materially affects the financial statements. So there was a really profound effect on this. So this was something that occurred very heavily in for the fiscal year 2020. A lot of companies had subsequent events disclosures related to fiscal year 2020. So this is talking about something that occurred after the balance sheet date of December 31st, 2020, but before the issuance of financial statements, which occurred, probably around mid-March, late March of 2021. Anybody want to guess what this? Or I guess I'm thinking 2019. Sorry, my years are off. So fiscal year 2019, and then in 2020, when the reporting was going on, some people actually disclosed subsequent events for something that was pretty significant that occurred right around March 2020. Anybody guess what it was? COVID, yes, the massive worldwide global pandemic that affected business operations worldwide. This is a prime example of subsequent events. It's also going to be an example of something we're going to talk about later, okay? COVID's a very illustrative example. The idea being is that it does not affect operations in 2019, did not affect performance in 2019, but had the propensity to massively impact performance for 2020. And this is a big point of contention for companies that were filing right around the time of the COVID crisis. Should they include this as a subsequent event in the financial statements? A lot of companies said yes, okay? This is going to profoundly impact our business because nobody's going to go outside anymore and buy things. They're going to stay out of public. They're going to domicile in their facilities, and they're going to buy everything off Amazon, which ironically, Amazon recognized record revenues in the year 2020. So for a subsequent event for them, it was kind of like, yeah, thumbs up. Everybody's going to have everything delivered to them. So subsequent events generally require recognition of the disclosure of the financial statements. Management is required to disclose the date through which the entity is considered subsequent events, and auditors are responsible for evaluating the entity's handling of subsequent events in the financial statements. So there's two categories of subsequent events we need to talk about. We need to talk about type 1 and type 2, which may be the 15th time we've talked about type 1 and type 2 as a category for something, but this is specific to subsequent events. A type 1 subsequent event is conditions that existed before the balance sheet date and affect estimates that are part of the financial statements, okay? So an example of this is our lawsuit example, okay? A lawsuit is pending as of the financial statement date, as balance sheet date, and then settlement occurs before the issuance of the financial statements. So in that situation, we know what the outcome of the lawsuit is. We as auditors are going to say, client, you need to now record the settlement of that lawsuit in your previous period financials because you know what the result is. There's no reason to accrue a liability anymore. You know what the outcome is, so make sure you record it. That's an example of that. That requires the adjustment to the financial statements, okay? Type 2 events, conditions did not exist at the balance sheet date and do not affect the accuracy of the financial statements. Example of this is like a natural disaster. So say you're in the middle of, you finish your financial statement year, you're in the middle of operating, and then all of a sudden a hurricane comes through and destroys one of your factories, all right? Did that exist at the balance sheet date? No, the hurricane was a pretty unpredictable consequence, especially in the months of June, January, and February, which would be weird for hurricane season. But yeah, hurricane comes and destroys a factory, and that's going to affect your operations. That's something that the client or your stakeholders will want to know about. Stakeholders will want to know about. So the auditor is going to jump in and say, yes, you need to actually disclose this in your current period financial statements. Even though it doesn't relate to the period under audit, they want to know about this particular piece of information. They also might require filing pro forma financial statements. What are pro forma financial statements? Anybody heard that term before? So pro forma financial statements are forward-looking financial statements based on certain assumptions. In this particular scenario, if we're talking about forward-looking financial statements based on a certain assumption, the assumption would be, what are the results of our operations going to look like after this natural disaster has occurred or after this event has occurred? So trying to project how this event is going to affect operations in the future. All right, everybody got a clear grasp on this? 100% perfect grasp, okay? I've noticed nobody nod their heads, so I'm glad nobody nodded their heads because I want to play a game here, okay? This is my favorite game to play in auditing. This is type 1 or type 2, okay? So I'm going to give you a subsequent event. You're going to tell me, is it type 1 or type 2? So let's get at it. Loss of the entity's manufacturing facility or assets resulting from a casualty such as fire or flood that occurred after the balance sheet date but prior to the issuance of financial statements. Type 1 or type 2? All right, holding up 2 fingers. Yes, this is a type 2 event, which in this situation will require disclosure and possibly pro forma financial statements, depending on this, how big the loss of the facility would affect the financials. All right, type 2. Capital stock or bond issuance by the entity after the balance sheet date, but prior to the issuance of the financial statements. This one's a little bit less obvious. What do you guys think, type 1 or type 2? See some people holding up 1s, some people hold up 2s, some people afraid to hold up fingers so they don't want to be wrong. This is come on, go with me. I know that you're there. Type 2 event, yes, okay. Circumstances did not exist at the balance sheet date. The bond issuance occurred entirely after the balance sheet date. So this would be something that our stakeholders would want to know about, but it does not affect reporting in the prior period. So it's going to be a type 2 event. Definitely going to be a disclosure, possibly pro forma financial statements. All right, settlement of a lawsuit after the balance sheet date, but prior to the issuance of financial statements for an amount different from the amount recorded in the year-end financial statements as a contingent liability. What do you guys think? 1, it is definitely type 1. Type 1. So what are we going to do? We're going to go back and we're going to make them revise the financial statements, okay? They actually have to reflect the adjustment to the financial statements as a result of the settlement of the lawsuit. All right. Loss of receivables caused by conditions such as a business failure arising subsequent to the balance sheet date. This should be pretty easy. What do you guys think? This is type 2. Yes, subsequent to the balance sheet date was the key there. So yeah, disclosure, probably not pro forma financial statements. All right. An uncollectible account receivable resulting from deterioration in a customer's financial condition prior to year end, about which the holder of the receivable is unaware, the customer declares bankruptcy after the balance sheet date, but prior to the issuance of the financial statements. This one's a tricky one, okay? So the deterioration was occurring prior to your end. That's kind of an important key to answering this question. What do you think, type 1 or type 2? Type 1, yes, type 1. The conditions did exist at the balance sheet date, even though the event did not occur until after the balance sheet date. So that was key. This one requires restatement of the financials to reflect the bankruptcy. All right. Purchase disposal of business by the entity after the balance sheet date, but prior to the issuance of financial statements, type 1 or type 2? It is type 2, a type 2 event. Did not affect the financial statements from the previous period, so we would just look at it going forward. Disclosure, possibly pro forma financial statements of the disposal of the business was significant enough to the entity's operations. What do you guys think? Want to do some more? That's unfortunate. I don't have any more, but I'm glad you guys got the enthusiasm there. I can see the eyes glistening with anticipation. It's just like we want more type 1 and type 2 events. This is the type of thing that makes a class great. Okay, that's the class great. All right. So what about what do we need to know about subsequent events? Well, first of all, we need to know subsequent events period is going to occur anytime from the financial statement date to the issuance of the financial statements. Now, in many scenarios that we're going to talk about, especially if we're talking about public company audits, a lot of times the audit report date will occur exactly on the issuance of the financial statements. That's something that auditors and public companies have gotten in the habit of doing, okay? In private companies, though, this is not always the case. The audit can conclude before the issuance of the financial statements. It, in fact, often does. So the audit report date is a date that is different and usually, or often, or should I say, always before or the same day as the issuance of the financial statements. So if we have a subsequent event that occurs during this window right here, before the audit report date, we know cleanly what's going to happen here. The auditor has to treat it as part of the testing, and they have to actually say, all right, client, you have a responsibility to report on this based on what type of subsequent event is. Hypothetically speaking, what happens if we complete our audit on February 15th, 2022, but then a subsequent event occurs right here, okay? Is that a possibility? Yes. Is the auditor responsible for that subsequent event? The answer is also yes. So we get into a situation of whether the auditor wants to accept responsibility for just that subsequent event or for all events that are occurring up to that point. And this is where we're going to get into the concept of dual dating. And by the way, I'm going to make the same joke that I've always made over time. It's like I grew up and a little bit older than you guys, but in the late 90s, early 2000s, there were a whole bunch of really bad reality dating TV shows like Blind Date and Fifth Wheel. And I always thought dual dating would be a really cool name for a TV show like that. Okay. But yeah, nobody ever takes me on it. Like I haven't had a student leave here. And so I'm going to become a TV show producer and do a really bad reality TV show just based on Dr. Barnes' recommendation. I wonder if I could get a producer credit on that, that could happen. All right. If anybody takes that and runs with it, keep me in mind. Okay. I won't ask any money. I just want the credit on the TV. Okay. All right. So what is the subsequent event thing? So a subsequent event occurs after the audit has been completed. The auditor considers the following options for dating the auditor's report. So the first option is basically a dual date. That means there's two different dates on the auditor's report. One date is the date the auditor's report was originally issued. So February 15th, 2022. The second is going to be the date of the subsequent event, or more specifically, the date after all testing of the subsequent event is concluded, okay? The idea being is that we as auditors are limiting our liability to that one specific event referenced. So say, for example, the subsequent event occurs on the 20th, then we as auditors test it and we conclude our testing on March 1st. We would have two report dates. We would have one where everything except for the subsequent event was resolved as of February 15th. And then we have a subsequent event date, the second date, the dual date at March 1st that said we tested this subsequent event. Here's where we eventually reconciled and resolved everything. So two dates. The goal of this is to limit our liability to that one event. The other possibility is changing the date of the audit report to the date of the subsequent event, or more accurately, like again, the date that testing completes of the subsequent event. This extends the liability because then the auditor is responsible for everything up until that report date. So changing the date till the testing of the liability. So remember the testing of the subsequent event. I said that occurred, that concluded on March 1st. We would change the audit report to March 1st. That means the auditor is saying a single report date, but everything that occurred up until March 1st, the auditor is now responsible for. They're extending their responsibility for that. So how do we actually identify subsequent events? What are we going to do? We're going to talk to management. We're going to read the interim financial statements if we have like monthly or quarterly financial statements that are available. Read meetings and minutes of the board of directors and other governance groups. We're going to talk to the lawyers. Again, the lawyers are going to be a good source of corroboration for us. We're also going to examine the books of original entry. And the books of original entry are basically the journals of which organizations enter to. Cash journals, purchase journals, sales journals, etc. Things along those lines. Also, something that we've alluded to, but I want to make sure that we reiterate here. An auditor has responsibility for subsequent events relating to internal controls over financial reporting. So the auditor of public companies, they're responsible to report on any changes on internal control that might adversely affect financial reporting between the end of the reporting period and the date of the auditor's report. So remember, we talked about internal controls, and I said the auditors have responsibility to make sure controls are operating effectively as of year end. With respect to internal controls over financial reporting, we also have a responsibility to make sure that these controls are consistently operating the same way through the period between the date of the balance sheet and the issuance of the financial statements. So if there is any abrupt change in internal controls over financial reporting that occurs during the course of the audit, the auditor is responsible for reporting on that. How are they going to know that information? We're going to look at internal audit reports. We're going to look at the independent audit reports or reportable conditions, which could be both us and other auditor groups. Any regulatory agency or groups that reports on ICOFR, oftentimes this is going to be the PCAOB that's doing check-in or oversight, and information obtained from the audit of internal controls over financial reporting. The idea being here is noting that if there's any significant or substantial changes in internal controls in this area, the auditor has to make everybody aware that the controls have changed. This will not affect the information in the period under financial statement period under audit, but it will affect users' perceptions of operations moving forward. Thus, it's considered a subsequent event in this category. All right. Now some long lists of things, because why not? Or why not? So what are some things that we're going to do at the very end? First of all, we're going to perform final analytical procedures. Remember we talked about analytical procedures back in chapter 5, and I said there were 3 phases of audit that we operated in. Preliminary analytical procedures, substantive analytical procedures, and now we have final analytical procedures. So quick reminder, of those, I said 2 of those are required. Does anybody remember which 2 are required by auditing standards? Ask you a question on a Monday afternoon and just really, really quiet here. Really, really quiet. All right. So I'm going to give you one of them. Preliminary analytical procedures are always required. So which one do you think is always required out of the remaining 2? Substantive or final? Final analytical procedures are always required as well. Okay, substantive analytical procedures strongly recommended, but they are not required. So this is a required step. Okay, this is a required step. What is the goal of final analytical procedures? It's basically to look at the financial statements and the financial statement information after the audit is concluded to see if everything makes sense. If we as auditors look and say, well, this is weird, gross profit is 25% higher than it was in a previous period, I don't know why that's the case, that might cause us to want to investigate further, perform further tests of details in those areas. So final analytical procedures is just kind of a wrap up to make sure everything looks sensible. All right, next we're going to have obtaining a manager representation letter, which is an example of this is on page 570 and 571. Manager representation letters are goofy, okay? What a manager representation letter is. Now, I'm going to describe it, but I'm going to give you a lot of details here, so make sure you capture everything, all right? This is a letter that is addressed from management to the auditor. Is everybody with me so far? I know I'm not giving you a lot of information, but I'm going to go through this slowly. From management to the auditor. It details all information, guidance, and reference, I guess is for lack of a better term, all information, guidance, and access. That's a good one. All information, guidance, and access that was provided by management to the auditor. So if a series of invoices were given from the client to us, that's going to be detailed in the manager representation letter. If we're able to talk to somebody in the organization about a particular piece of information, that is going to be detailed by the manager, provided by the manager. Okay, so basically anybody we talked to, any information we were given, any guidance that was provided by the client, all of that is detailed in the management representation letter. Now, here's the question I want to propose to you. Do you think management is tracking every single little thing the auditor is doing over the course of the audit? Probably not, but this responsibility is the representation letter says the management is going to detail all of this in this letter. So here's the weird thing, okay? This is addressed from management to the auditor. But the weird thing about this is the auditor is the one that's going to write this letter. Because the auditor is one tracking all this information. All right. So they write all this detail down and say, okay, management gave us access to the accounts receivable clerk, and we talked to that individual. Then we got all these documents related to accounts receivable for customers for our testing, blah, 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 blah. All of this is going to be listed in the management representation letter. The auditor is going to deliver that management representation letter to management and say, here's everything you gave to us. Please sign it so that we can actually have this management representation letter. And management's going to say, oh, looks good to me. And then they're going to give that to auditor. All right. So it's a really weird document. It's addressed from management to the auditor, but the auditor writes it. Does everybody see why I say it's weird? Yeah. How many times have you written a letter to yourself and basically had somebody else sign it? Okay. I'm gonna have you guys get in the habit of that so you can see how weird that is. It's a phenomenon. So that's my assignment for y'all for Wednesday. Write a letter to yourself, but have it addressed from somebody else. No, you don't have to do that. I'm just joking. Just joking. That would be weird. That would be weird. Review the working papers, okay? So what are the things that we're going to be doing? So first of all, when we talk about review of working papers, this is usually the engagement partner, the partner who's responsible in charge of the engagement. They're going to be looking for two primary things. The sufficiency of audit evidence. We talked about sufficiency. Is sufficiency quantity or quality? What do you guys think? Sufficiency is quantity, okay? Appropriateness is quality, but primarily the audit partner is going to be making sure, do we have enough audit evidence to support our opinion? So sufficiency of audit evidence. And also the effects of effects of detected misstatements. The effects of detected misstatements. In other words, materiality. What is the materiality of the detected misstatements in the audit? Again, this is the engagement partner that performs this initial review. That's important to note. Then we want to look at the final evaluation of audit results. Make sure we understand what is our opinion going to be issued, and is all of our information consistent with that opinion. This is really important because if we have information that's inconsistent with that opinion, that still has to be included in the working papers. Now, we want to understand why, if we have information that's inconsistent with our opinion, we didn't include that information in our judgment. So we want to make sure everything points in a specific direction. Then we're going to evaluate financial statement presentation and disclosure. This is a really important step because under PCAOB standards, all of our companies have to report under one specific set of guidelines, U.S. Generally Accepted Accounting Principles, GAAP. So we want to make sure our client is reporting properly according to GAAP. If we're talking about other clients, then it would be whatever the agreed upon criteria is that we agreed for the audit. But for PCAOB clients, we're going to be talking about GAAP. Next, we're going to obtain an independent review of the engagement. All right, back up here. Who did I say was responsible for this step right up here, this reviewing working papers? That was the engagement partner. Okay, that was the engagement partner. Who's responsible for this independent review down here? Is it still the engagement partner? That word independent probably gives you a clue. Okay. Usually when we talk about an independent review of the engagement, this is going to be a non-engagement partner. Okay, a non-engagement partner. Now, let me ask you all a hypothetical situation. If we're talking about a firm like KPMG, there's probably plenty of partners to go around. Okay. Talking about a firm like EY, plenty of partners to go around. What if we're talking about a firm performing audits here in Kirksville that has exactly one partner? We have one partner up here who's reviewing the working papers. There's not a second partner to perform that independent review. What do you think the solution to this problem is? So for an independent review, we could also ask another accounting firm to perform that review for us, another public accounting firm, in the scenario where we don't have a second independent partner that can perform this review. It's uncommon that occurs, especially for large engagements, but to smaller engagements, that can happen. Also, we're going to evaluate the entity's ability to continue as a going concern. Make note of that term. We're going to talk about it more here in just a second. It's a really important one. But we're going to talk a lot about going concern here in just a little bit. We're also going to talk about it when you get back from spring break a lot. But PCAOB Auditing Standard 1215 and Sarbanes-Oxley Act of 2002 require audit firms to archive their public company audit files for retention within 45 days of the completion of the audit. So the date that audit report is issued, they've got 45 days to ready everything and get it into archive so that it can be retained. How long is the retention period? The answer is 7 years from the completion of the audit. So once the audit is completed, you have to hold on to those files for 7 years unless a longer period of time is required by law. This usually happens when we've got a fraud that occurs and there's going to be some significant liability on the part of the auditor. I would say the Enron files, those that still remain, those that Anderson did not shred, are probably never going to go away. They're probably going to be archived perpetually. By the way, this is PCAOB guidelines. For Auditing Standards Board guidelines, the AICPA, the numbers are a little bit different. They require a little bit more of a lax time period. It's 60 days within the completion of the audit, and they only retain for 5 years, okay? Might I test you on that? Who knows? I haven't in the past, but maybe I'll feel whimsical. Okay, 60 days and 6 years for private company audits. They retain all documents that form the basis for the audit review, but they also include any information that is inconsistent with the issued opinion. So any information that supports the opinion that you rendered, that goes in the documentation. Any information that does not support the information that you rendered, that also goes in the documentation. Basically, you can assume that everything that's relevant goes in the documentation. That's all there really is to it. It's not documented, it's not done. That's something we talked about back in chapter 5. All right, let's talk about going concern. Has anybody heard that term before? So that's a website that you talked about, Dr. Barnes. It's really right. There's actually a website called goingconcern.com. It's one of my favorite websites. I haven't been there in a while, but it's pretty what's the word I'm looking for? Pretty relaxed. It's doesn't take itself very seriously. What I'm talking about with going concern is this something called based on auditing standards update, disclosure events introduced by the accounting standards update, excuse me. Entity's ability continues as a going concern. So FASB basically says that management has to assess the entity's ability to continue as a going concern. If I say that I'm a going concern, is that a good thing or a bad thing? So Dr. Caden walks in down here and she's just kind of like, she's saying, I'm really upset with Dr. Barnes right now, but I think he's gonna remain a going concern. Is that a good thing or a bad thing? My remaining a going concern is a good thing, at least as far as my position goes. I don't know. Some of you may have different positions, but I would like to remain a going concern at Truman State. All right. I would like to be here a year from now. Going concern basically says that things will be in place for the foreseeable future. All right. Under PCAOB auditing standard 2415, the external auditor must evaluate whether there is substantial doubt about a client's ability to continue as a going concern for a reasonable period of time, which is usually a 1-year window. So if I'm going to say I'm a going concern, then I think I'm going to be teaching here a year from now. And thankfully, I still think that's okay. No matter how many jokes I pull on Dr. Caden or Dr. Otero, I think I'm still a going concern here at Truman State University. All right. But as far as audit goes, audit concerns we're talking about, what do we need for the auditors? Well, the auditor has to evaluate a few things, okay? 3 overall steps. Do the audit procedures indicate substantial doubt exists? So we're going to be looking at our client and determining, look, we're here to audit your financial statements, but we also think you've got business problems. So if we think that substantial doubt exists, then we're going to step up to our client and say, yeah, there's a problem here. So we're going to go talk to management. We're going to say, what is your plan to address this problem? How are you going to make sure that your business is in place a year from now? And they're going to explain it to us. And if we're happy with that explanation, then we're going to stop. Okay, we're going to move on. But what happens if we still have substantial doubt? Well, at that point, we're going to say, client, you have to disclose this information in your financial statements. ASU 2014-15 says you have to disclose this information in your financial statements. That's required by GAAP. Okay. We as auditors also have to add this to our audit report. We have to add information about going concern disclosure in the audit report, saying that we have concerns about this, we have substantial doubt about the entity's ability to continue as a going concern. Now, there's a couple of pieces of information that are very important here. All right. First of all, when I talked about the pandemic, the COVID pandemic, this was an area of going concern for many organizations. And a lot of companies had to actually issue this report or this type of opinion during that time. Or this not this opinion, it's the wrong word, this disclosure. Secondly, I want to make sure we're very clear, and this will become a lot more apparent when we get to chapter 18, but I want to make a note about this now. Okay. The existence of substantial doubt about the entity's ability to continue as a going concern does not change the auditor's opinion on the financial statements. So substantial doubt does not equate to a bad opinion. They're 2 separate issues. Okay. Remember, our report or opinion is based on whether the financial statements are free from material misstatement. They can have good financial statements and still have a bad business model. All right. Still be in trouble for business. Their financial statements could look great, but it indicate they're going out of business. That being said, if the client fails to disclose the going concern issue, that would change our opinion because that is required by generally accepted accounting principles, that disclosure is. So the existence of substantial doubt does not equate to opinion change, but failure to disclose substantial doubt about the entity's ability to continue going concern would affect our opinion, because that is something that's relevant to GAAP. We'll talk about this more when we get to chapter 18. It's a little bit confusing, but I want to make sure we're very clear on that, because one is not the same as the other. All right, to wrap up, auditing standards require the auditor to communicate the following matters to the board of directors and the audit committee. So first of all, what are our responsibilities? What were the terms of the engagement? Also, information that was provided to the audit committee is relevant to the audit. Also, information during the planning phase that was relevant to the overall audit timing and strategy. Any timely observations to the audit that are significant to the financial reporting process. We already know about significant deficiencies and material weaknesses. Those were talked about. We talked about those in chapter 7. Those are required to be reported by the auditor. And then we are going to provide a management letter. And you'll notice I said this is not to be confused with the management representation letter for any remaining recommendations to the client. So the management representation letter, that was from management to auditor, but written by the auditor, which is a really weird, wonky letter. The management letter is basically a letter from the auditor to management with any recommendations regarding internal controls. All right. That was a big, long list. Most of it's not particularly relevant, but basically this is kind of a short list of the information that we would provide to the audit committee. The stuff that's really important is stuff that we've already talked about previously. Let's talk about one last issue. So you finish your audit, okay? And you do like every auditor does. You go and sit on the beach in Hawaii and you're going to go sip a, mojito? That would be a good drink for you guys. Everybody cool with mojito? All right. We'll say alcohol free for mojito if you just don't drink, okay? But whatever your drink of beverage is, something in a pineapple. I guess a pina colada would be more appropriate in that situation. But you're on the beach in Hawaii, your client contacts you and say, hey, you know that unqualified opinion you rendered on our financial statements? We should probably tell you there was a giant warehouse of inventory that we forgot to tell you about. And we think it's material to the financial statements. So in that situation, you're going to get up, you're going to get on a plane, you're going to go visit your client and say, all right, I'm ready to audit the inventory. And if the client says, all right, have at it, make any changes that are necessary, that's great, okay? We're not too concerned. We can do audits after the fact if it was completely and totally unintentional on the part of the client. What happens if the client says, you know what, we're really happy with our unqualified opinion. We think if you audited this warehouse, that would change your opinion. We would rather you not perform this audit. That's where things change. At that point, we're basically going to say, here's the deal. Our financial statement audit was performed on incomplete financial statement information. We rendered an opinion on information that was not correct. So you can't use our audit report anymore because that audit report is conveying information that's inaccurate. We're also going to reach out to those regulatory authorities that are relevant in this area, usually the SEC, okay, and basically say, they can't use our report, you can't rely upon their report anymore. Most importantly, we're going to notify each person known to the audit relying to the financial statements and let them know about the situation. If we're talking about a public company audit, the SEC will do that work for us. If we're talking about a private company audit, we might want to know notify any important stakeholders, any important organizations that were relying on that information. Like if we did the audit for purposes of issuance for a loan from the bank would want to know that. Basically, we're just communicating, you can't rely on our audit report anymore because it's based on incomplete details. And we were not given the option to test these new details. Therefore, the audit report is invalid. It's rare that that comes up, but if it does come up, it's a really important communication because you could be held liable for the information that's conveyed in the audit report if not properly disclosed. All right, and I think that does it for chapter 17. I will see you all on Wednesday for our activity.